And now moving on to the second most important subject of the day, the Fed's decision and Jerome Powell's speech. The Fed is a very confused organization. They have no clue what they're doing. Jerome Powell is choking all over the place. And of course, once the COVID crisis hit, he panicked and he realized that he should open the floodgates of liquidity, and that is supposed to solve all the problems, and the president will not be mean to him again. And what happened with all the flood of the liquidity is we've wasted trillions of bucks, adding trillions to the national debt and to the budget deficit. And we have yet to see any positive impact from the trillions of dollars of liquidity that the Fed drowned the market and the economy with. All we've seen so far is the creation and survival of zombie companies and very wealthy companies like Apple getting more free cash and access to free cash. They didn't solve a damn thing in the real economy. And of course, there are concerns that the Fed's policy of quantitative easing on steroids, and of course, their decision today of keeping interest rates at zero pretty much all the way to 2023. The question is, that would create an asset bubble, an inflation in the assets market. It would not necessarily translate to inflation, good inflation that is, in the micro economy. And when Jerome was asked this question about the bubble, he sounded absolutely clueless. He had no idea what he was talking about. All he said is, hey, we've been doing quantitative easing for years and years, and we didn't see any bubble, even in the housing market. Even Stevie Wonder can't see the bubble in the housing market. Yet Jerome, the Fed chairman, says, oh, there is no bubble in the housing market. And there is no bubble in the stock market, and even if there is, we haven't seen any negative consequences from that. So we'll just keep an eye on it and we'll monitor it, and that's that. And of course, we all know that the bubble is there and it hasn't bursted yet. Keyword yet. When that happens, you will see severe economic downturn and severe economic consequences. So let's hear what this moron said about the bubble today.
If I could follow up, in terms of the balance sheet, are you concerned that your actions are more likely to produce asset price inflation than goods and services inflation? In other words, are you risking a bubble on Wall Street?
So we monitor financial conditions very carefully. These are not new questions. These were questions that were very much in the air a decade ago. And more when the Fed first started doing QE. And I would say if you look at the long experience of, the 10-year, 8-month expansion, the longest in our recorded history, it included an awful lot of quantitative easing and low rates for 7 years. And I would say it was notable for the lack of the emergence of some sort of a financial bubble, a housing bubble, or some kind of a bubble, the popping of which could threaten the expansion. That didn't happen. And frankly, it hasn't really happened around the world since then. That doesn't mean that it won't happen, of course it's something that we monitor carefully. After the financial crisis, we started a whole division of the Fed to focus on financial stability. We look at it from every perspective. The FOMC gets briefed on a quarterly basis. At the board here, we talk about it more or less on an ongoing basis. So it is something we monitor, but I don't know that the connection between asset purchases and financial stability is a particularly tight one. So, but again, we won't be just assuming that. We'll be checking carefully as we go. And by the way, the kinds of tools that we would use to address those sorts of things are not really monetary policy. It would be more tools that strengthen the financial system.
And of course, the Fed keeps talking about their concerns about wealth inequality. But Jerome today said, well, we are concerned about it. We keep monitoring the situation, but we have no tools to address income and wealth inequality. That is for the federal government. But Jerome forgot that the source and the reason for wealth inequality is the Fed inflating asset bubbles, asset prices by the tsunami of liquidity and free money to public companies and to the wealthiest people in the world ensures that the rich will continue to get richer no matter what. There is a Fed put that would prevent the assets of the wealthy from declining. And that, of course, widens the gap between those rich people in our society who own and control asset prices, and of course between the poor and the middle class who are seeing their wages stagnant and declining, and they have very little ownership in asset prices. But of course, Jerome was all over the place. He was choking, clearing his throat. He couldn't talk. He couldn't put two sentences together. And I think, of course, the market understood that the Fed is out of touch and Jerome has absolutely no clue what he's doing. All what he's saying, oh, we're projecting, we think this happened. Well, we don't know. It's unclear. It's uncertain. Yet he's making decisions as if things were certain, and then saying, oh, but we're going to be flexible here, flexible there. We have a wide variety of tools, all the dancing back and forth. The market caught up to the bullshit from Jerome and sold off, of course. Needless to mention, of course, the absurd mentioning of the word powerful today. Jerome keeps saying that his decision today and the Fed's decision and forward guidance are powerful, very, very powerful.
And today we believe that particularly this very strong forward guidance, very powerful forward guidance that we've announced today will provide strong support for the economy. Effectively, we're saying that rates will remain highly accommodative until the economy is far along in its recovery. And that should be a very powerful statement in supporting economic activity. Now we're buying 120 billion in securities per month across the Treasury curve. That's also adding to accommodation. We do have the flexibility to adjust that tool and the rate tool and other tools as well. But as for right now, we think that our policy setting is appropriate to support the expansion. We said from the beginning that we would first try to provide some support and stability and relief in the first phase of the crisis, the acute phase, and then we would support the expansion when it came. Well, it's here, and it's well along, and so that's why we changed our guidance today, and we do have the flexibility to do more when we think it's appropriate.
And of course, this is the mind games and the trickery and the stupidity of the Fed, thinking that we are a bunch of children who are not gonna catch up to what the Fed is doing. The Fed wants to keep interest rates as low as possible for as long as possible. And they know, of course, even with that, inflation never picked up. And they need inflation to motivate companies and employers to start spending and hiring employees, thus recovering the economy. Understand that this is what the Fed is doing. They're saying our forward guidance is so powerful, meaning that they're playing psychology games, telling me and you and corporations out there and employers out there that inflation will increase. We will let inflation increase all the way over 2%. So you guys better start employing now. You better start spending now. And you consumers out there, you better go out and start consuming before prices get higher. Of course, we know that this is bullshit because it hasn't happened the last 10 years, even with quantitative easing and the lowest interest rates ever. So the question is, what if the psychology game doesn't work out and employers don't spend and they don't hire because they don't need to expand right now? And of course, consumers don't go out and spend, even with the threat of inflation from the Fed, because we don't have purchasing power. We lost our jobs, we lost our savings, we're not getting unemployment benefits, we're not getting stimulus right now. So how the hell is inflation going to increase? And how the hell is the threat of increasing inflation will somehow magically work its way in the economy and will recover? But this is the Fed, of course, waving the white flag, saying that we've done everything we could and we're out of ammo beside playing psychology, and maybe we can go to the nuclear option of negative interest rates and controlling the yield curve and straight out buying stocks. But even that will not help the economy overall. And of course, they're relying and they're trying to portray that it is now on the lap of the federal government to conduct fiscal policy, aka spending and more stimulus. And the Fed is saying, hey, government, we'll buy treasuries like there is no tomorrow. You need $1 trillion, $2 trillion, $3 trillion, $5 trillion, $10 trillion, doesn't matter to us. We'll print. You just have to pass the damn bill. As far as who's gonna pay the bill later on the road, who cares? Who cares? In a few years, we're not gonna even have a country anymore.